Hello and welcome to Startup Street. I'm Arundhati Ramnan and with me is Shruti Mishra. These are the top headlines from the startup space. Uber signs a memorandum of understanding with Tata Motors to induct 25,000 electric vehicles to its ride-sharing fleet in India over the next 3 years. This marks the largest four-wheeler EV fleet order for the Indian industry.
BharatPe announces the appointment of Aparna Kuppuswamy, an ex-CBI Cards senior executive, the company's chief risk officer. This comes as another top-level move into the company from the State Bank of India after former SBI chairman Rajneesh Kumar.
TRAI officials say they've observed a rise in the prices of 5G devices as compared with the devices that only supported 4G to issue consultation paper aimed on device availability and pricing as a part of digital inclusion, officials told CNBC-TV18.
Mark Zuckerberg takes a leaf out of the Elon Musk playbook. After Twitter, now Facebook and Instagram users will have to pay for a blue tick. Meta to roll out paid verification service first in Australia and New Zealand this week, followed by United States and other countries.
Users can now soon earn money from Twitter, says Elon Musk, spinning up subscriptions so that users can charge for some content for which followers can pay with a single click, says Musk in a tweet.
A major setback to ride-sharing platforms like Ola, Uber and Rapido. The Delhi Transport Department issued a public notice asking platforms to stop their bike taxi services as they fail to comply with the Motor Vehicle Act 1988. The Transport Department highlighted that the violation of this will result in a fine of 10,000 rupees and imprisonment. Those are the headlines we're tracking for you this evening. Venture debt fund Stride Ventures has launched the second edition of its India Venture Debt Report. Now, the report highlights the potential of B2B replacing Fintech in 2023 for the most attractive sector for venture debt, closely followed by consumer and EV. Further, the survey accentuates the investor sentiments of venture capitalists and startup founders with respect to various factors driving the venture debt ecosystem. And to elaborate on the key highlights of the report, joining me now is Apurva Sharma, partner at Stride Ventures. Also joining me is my colleague Arundhati. Apurva, welcome to Startup Street. The survey has found that, in 2023, 82% of founders are saying that they will strive for profitability and prioritize scaling their startups, while 79% of VCs expressed a focus on profitability and 21% want to focus on growth. Now, these numbers are in contrast to last year when 55% of VCs and 68% of founders focused on growth rather than profitability. Talk to us about this change in stance.
So first of all, thank you so much for having me on this platform, and we are delighted to launch our second edition of the Venture Debt Report, which gathers some great insights of how this asset class has evolved over the last couple of years in India. So naturally, I think everybody now knows that there is a funding winter in the startup ecosystem, and because of muted venture capital sentiments, and given that late stage companies are deferring their primary capital raise, substituting some bit of debt, to maintain the capital requirements in the business, given that they're not really certain of the kind of valuations they'll be able to fetch in this market. So access to capital, large checks, as well as valuation is a big question mark today, mostly for late stage companies. And that's why the inherent inclination for VCs and founders both to focus on profitability more than growth this year.
Okay. Speaking about profitability and our focus on profitable unicorns on Startup Street, Apurva, talk to me about your portfolio companies. How are they doing in terms of profitability? Also, if you could talk about the balance sheet of your star portfolio companies and what is the sense you're getting as they cut their losses?
So I think most of our portfolio companies now, we have more than 100 companies in our portfolio across the length and breadth of startup ecosystem, across consumer, B2B, B2B SaaS, financial services, consumer health, clean energy, EV mobility, etc. So I think a lot of companies have been able to prune costs. You might have seen there have been massive layoffs across the startup ecosystem to make sure that they extend the runway, focus on improving their unit economics, and then go out in the market for a strong fundraise. So most of the companies in our portfolio are doing well. We have about 9 portfolio companies that are unicorns, like Rebel Foods. There is Cred Avenue, now rebranded as UB, Inframarket, Good Glam Group, etc. And yes, I think most of them are doing good. Some of them definitely have to figure out better unit economics and how to make sure that they extend their runways longer.
Right, so most of your portfolio companies doing well. Hi, Apurva, Arundhati here. Now, your report also highlights the fact that B2B will replace Fintech in 2023 as the most attractive sector for venture debt. Tell us why you expect this to happen. What are the other sectors apart from B2B that are on your radar as well?
So I think fintech definitely was a very prominent sector for venture debt, naturally, because onward lending is a very proper debt use case. Onward lending, financing of FLDG, the first loss default guarantee by debt rather than equity to save dilution, as well as acquisition financing. These are the three top use cases for venture debt in fintech. With the new DLG, the digital lending guidelines, how much FLDG can these fintech providers block with their co-lending partners is a big question mark. And a lot of people are, just trying to understand how to, make sure they're not breaching any BNPL guidelines, any DLG guidelines, etc. And hence, I think, there is a little bit of dip in venture debt deployment in financial services in fintech specifically, which we feel can be replaced by B2B. There is massive interest in B2B companies, and given their inherent working capital requirement in their business, it's a proper debt use case. The other sectors that we find interesting remain consumer. There is a lot of appetite for debt in EV also, given the capex requirements, whether it's a OEM or a charging infrastructure operator, etc. So there are inherent debt requirements. So we find EV also, good at the moment in terms of deployment potential.
So consumer, EV and B2B. Now, the survey also revealed that 71% of founders of early stage companies plan to raise venture debt in 2023 versus the 50% of late stage founders and 20% of growth stage founders. So what's attractive about venture debt to these companies?
So in early stage, I think the deal momentum from a VC perspective also remains solid, right? Any check size below, say, $25 million is being well supported by the domestic VC investors. So we still see good momentum in the early stage investors, in the early stage segment of startups. And hence, given that venture debt and venture capital are a pretty married asset class, they move in tandem. Given that there's a lot of deal momentum in the early stage, there has to be eventual venture debt deployment also in that stage.
Okay. Apurva, the survey results, also highlighted the fact that 62% of founders and 44% of VCs consider engaging with bank limits as the most important value-added service offered by a venture debt fund. Can you explain to us what this means and what are the other most preferred services?
Sure. So banks, as you may know, have now, various of the Indian private banks have new economy groups, the NEG groups, which want to increase their quantum of deployment amongst startups. So if you are able to help them get the right kind of banking facility to reduce the blended cost of debt and blended warrant percentage that is attached with venture debt as an asset class, it becomes a very attractive proposition. Plus, bank debt can be scaled over a period of time, and you can keep lowering your cost of capital. The other value addition would be, just advising them on how to use non-fund based limits like an LC or a BG better, how to just make sure that they're doing a good job at their capital structure, a good mix of debt as well as venture capital. Also, how they can use other embedded supply chain financing solutions like customer financing, vendor financing, dealer distributor financing, and those kind of structures to make sure they're optimizing working capital in their business.
All right, and finally, Purva, the survey indicated that agri-tech, health tech and SaaS sectors are receiving future venture debt prospects according to founders and VCs. What's the reason for this?
So agri-tech also, most agri-tech companies in India are actually market linkages. Right. So there is some bit of B2B element in it or B2R element in it where, you're procuring the feed or F&B, etc., right from the FPOs of farmers, and then distributing it to the kirana stores and retailers. So there is an inherent working capital mismatch in most agri-tech companies, given that most of them are market linkage oriented, and hence the deployment of venture debt comes into play.
All right, we're running out of time, but if you could quickly tell us what's your outlook for startups in 2023 and what do you think will be the key challenges as well for Indian startups going forward?
So I think 2023, people expect that the first 3 quarters will continue, remaining muted in terms of the equity appetite. And hence we'll see a lot of deal volume on the debt side because a lot of these companies will look at debt for runway extension or substituting some bit of their primary capital requirement to maintain the growth that they want. But we remain cautiously optimistic. Given that there is a lot of deal volume, we'll continue maintaining the strong momentum that we have had. Stride has disbursed, sanctioned about more than $340 million till date, and we remain to be one of the most active venture debt players in the ecosystem. We'll continue deploying, but of course, we have to remain cautiously optimistic because the first 3 quarters, we don't see a huge uptick in the venture capital deployment.
Okay, so a lot of deals and uptick in the volume of deals on the debt side. Apurva, many thanks for joining us on Startup Street and wish you the very best with all your future plans.
Thank you so much. Thank you so much for having us.
Moving on, the recent economic survey said that the rise of the digital economy, smartphone adoption and increase in digital payments have accelerated the e-commerce market, which is projected to grow at 18% annually through 2025. My colleague Ritu Singh spoke with Kapil Makhija, the CEO of Ecommerce, and Sahil Goel, the co-founder and CEO of Shiprocket, on the emerging trends and changing consumer preferences in the e-commerce market. Take a look.
We are quite bullish on the overall e-commerce growth story. Even in a recent study that we published along with Wazir Advisors, we projected that the overall e-commerce market is expected to grow to about $225 billion in the next few years. I think some of the trends that we are seeing right now are that not only are we seeing big metros growing, driving the e-commerce growth, it is the smaller towns, tier 2, tier 3, which are driving a lot of growth. And more importantly, we are seeing a new trend in terms of the D2C brands becoming house of brands and new roll-up firms coming up. And now I think we will see an era of them focusing on sustained unit economics and profitable growth. And more importantly, we will see as the ecosystem starts to get built around this, we will see more and more brands come from India going global. So we are quite bullish on the overall e-commerce growth story coming from India.
And Sahil, what is your own sense? What kind of volume growth are you anticipating this year? And is all of this going to translate into profitability for Shiprocket anytime soon? You posted losses in FY22. You've been on an acquisition spree as well last year. What is all this going to mean in terms of your financials as well?
No, I think completely agree with Kapil there. E-commerce is bound to grow. India is a 6% penetrated market in terms of retail. Even countries like US are at 15, and our GDP growth is the fastest in the world at the moment. So the only way this is going to go is up, and that's a very normal way digital gets adopted. At the same time, I think omni-channel is a big theme, which we think this year both online brands going offline, offline brands going online, and tier 3 cities and beyond commerce, or Bharat commerce as we like to call it, is also a big thing that we are noticing in our data. I think that theme will continue over the next 5 years as the next 300-400 million internet users come online. And everything Kapil said about D2C brands, about e-commerce growth in general, completely agree with that. As far as our profitability is concerned, I think we are very much, it's on the cards in the next few quarters, and we've grown over 100% every year since the last 3-4 years. So I think it requires investments as well. But yeah, as you said, we are on an acquisition spree, and it should continue this year as well.
Okay, so we see more acquisitions from Shiprocket coming this year as well. Kapil, back to you. We've been talking about the incorporation of technology into logistics, AI, cloud, and whatnot, delivery via drones, dark stores. With all of this, are we at an inflection point for the industry, or what do you think are the major tech trends that may be game changers for the industry?
So I think some of the trends that you rightly pointed out are some of the new emerging themes that we are seeing, which is growth of hyper-local commerce, emergence of dark stores. We are seeing a lot of D2C brands, even in discretionary categories like fashion, investing in dark stores to make sure that they're able to deliver goods much faster to the consumers. Because the new age consumers are living in the Blinkit, Instamart era where every minute to the delivery counts. I think we are seeing a lot of brands invest in that direction. And more importantly, in the tier 2, tier 3, or the Bharat that Sahil referred to, is where the most of the growth is expected to come in the next 4 or 5 years. We are seeing a lot of investment of warehousing and logistics in those areas to make sure that the delivery times in those areas can go down. The second key trend we are seeing is newer categories emerging. So a lot of supply chains got set up for fashion and electronics, which drove growth until now. But we saw beauty and personal care category, pharma categories demonstrate growth in the last 2 years in the pandemic era. And now we are seeing categories like pet care, baby care, and many sports, home decor, etc. coming up, which will require different sets of supply chain coming in, and we will see technology investments in these to enable these supply chains. And as brands get into a house of brands category, this multi-category supply chain will become the flavor, and the technology will have to support this evolution in the supply chain.
Sahil, what is your sense? Which of these business models will sustain, will thrive? Because companies are burning a lot of cash, some of it may have to shut down. And also, if I could ask you, these changes in consumer preferences that we've seen in the past 2-3 years, thanks to the push from the pandemic, the technology, how many of these are really reversible trends, and how many of these are permanent shifts that are here to stay?
I think convenience will trump selection, right? And profits will follow. Look, for any ecosystem to develop, there has to be investment, and there are going to be things which will work and things that will not work. But it will elevate the ecosystem for everyone, and it will allow people to kind of, move forward. So I think it's important to give people that chance to be able to innovate. And at the same time, completely agree with Kapil. Eventually, every business's job is to deliver profits. So sooner or later, business models will change. Demand will get more dense. And it will work out.
One line answer from both of you. Kapil, starting with you. What is the volume growth Unicommerce is expecting in 2023?
I think we are hoping that similar volumes that we've seen in the last 2-3 years, so anywhere in the range of 30 to 40% e-commerce volume growth, we expect to do even in this year.
Okay, and Sahil for Shiprocket?
I guess if the question is how e-commerce in India will grow, I align with Kapil on saying it will be between 35 and 40%. From a Shiprocket perspective, like I said, we expect to grow between 70 and 100% every year, and this year is no different.
All right, Kapil and Sahil, both of you, thank you very much for your time here on Startup Street. Pleasure speaking to both of you.
All right, so looking at 30 to 40% volume growth for Unicommerce and 70 to 100% volume growth for Shiprocket in 2023, say the founders. It's now time for a short break. Coming up on the other side, the special series, the Unicorn Health Check. And today, the spotlight is on fintech startups. Stay tuned.
Welcome back. You're still with us on Startup Street. We're kicking off a special series called the Unicorn Health Check with the aim to create a report card of our most valued startups, delving deep into what's working and what's not. Today, we will look at Fintech, which is a sector with the most number of unicorns in India. My colleague Akhil Vishwanath joins us now with the report card. Akhil?
India is home to 17 fintech unicorns, followed by SaaS and e-commerce with 16 each. Interestingly, if you exclude Paytm, all of India's fintech unicorns have been created post-demonetization, the moment that ushered India into the age of digital payments. Cumulatively, over 7,000 fintech startups in India have raised over $30 billion till date, most of which have come over the last 2 years. Now, that's after the pandemic brought the biggest digital shift in the financial services industry since demonetization. By the end of FY21, fintech startups had control over 8% of India's $1.4 trillion BFSI industry. By FY26, their share could rise to more than 15% for a $350 billion chunk of the market. Now, what's fueling these market share gains is India's rapid adoption of fintech. At 87% adoption rate, India's financial industry is going digital faster than the world. Now, that's both an opportunity and a challenge. As we can see, there is still a long way to go when we look at the general population, where the penetration stands at about 25%, and when we talk about credit to MSMEs, the fintech penetration stands at about 15 to 20%. Now, India's fintech landscape is certainly changing, and it's going beyond just payments. If you look at the list of unicorns, it gives us a clear picture. We have credit card challengers like Slice and OneCard, MSME financiers like Oxizo, and even a marketplace for loans like Cred Avenue. Now, let's take a stock of financial health of some of our top fintech unicorns. Now, let's start with PhonePe. India's most valued fintech, PhonePe also rules the UPI market with nearly 50% market share. But the zero MDR regime has meant a struggle to monetize UPI transactions. In FY22, PhonePe spent 2.25 rupees to earn a single rupee of operating revenue. Now, losses for FY23 could also be higher due to tax loss after the Walmart-owned company recently shifted its domicile to India. It is now in the process of closing a $1 billion funding round to scale new verticals such as lending and stockbroking. Next up is BharatPe, which is fighting multiple battles at multiple fronts. The soundbox battle with PhonePe and Paytm, and a power tussle in the boardroom. And even as the legal battle continues, BharatPe continued to burn cash, 3.25 rupees for every rupee earned. Although its 5,600 crore loss was attributed to an accounting change, it was the highest reported by Unicorn in FY22. Now, moving away from the QR code players, let's take a look at the fintech that is profitably becoming a full-stack player, Razorpay. And now Razorpay, alongside Oxizo, is amongst the only two fintech unicorns that are profitable. And besides SaaS, Razorpay is also amongst the few homegrown unicorns that are making a global foray. Now let's bring up the curious case of Open, the Tiger Global-backed neobanking platform, which is amongst the least funded fintech unicorns, but is the most overvalued at 195 times its FY22 revenue. Loss stood at 4 times its revenue, with a cash burn of 5.5 rupees to earn a single rupee of operating income. But that's a big improvement on 14 rupees spent to earn a single rupee in FY21. Now moving on to the last of our report cards, which is for Cred, which is, by the way, the most famous now for its quirky ads with the likes of Olympic medalist Neeraj Chopra and Kapil Dev. Now, this kind of a marketing strategy seems to have paid off with a 4x growth in FY22 revenue. But it has certainly come at a cost. The burn stood at 4.3 rupees spent for every single rupee in FY22. Now, that's where the fintech ecosystem stands, and while monetization, regulatory scrutiny, and tighter liquidity continue to be big challenges, the growth is being led by UPI, which, by the way, has gone global.
All right, Akhil, many thanks for those details. But with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
MCX Zinc Mini Futures Contract